presentation contains current opinions of Moe Javaid, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone and welcome to the Compak Market Wrap Weekly Update for May the 11th, 2026. I'm Moe Ansari, President of Compak Asset Management, joined by Javaid Ansari, Executive Vice President. Thank you for joining us today. Quick housekeeping note, click on the subscribe button so whenever we post an update you can come and listen to it at your convenience. Also, you can go to compak.com, click on Insights, and you can get all the updates there. If you need help with your portfolio, give us a call, 800-388-9700, or send us an email at invest@compak.com. Javaid, let's start with the numbers. Another good week in the markets.
Yeah, so we're just continue to just make all-time highs. S&P up 2.4% last week. Now we're up almost 8.5% for the year. Dow not quite up as much, only up 0.25%, only up 3.5%. Talk a little bit about that, particularly when you look at value stocks. They were up 1.35%, but really it's been the growth story so far this year, in the last month. You still look at value stocks, it's kind of interesting. They're up 11, 12% for the year. Growth stocks are only up 5%. So growth stocks really took a hit, early start the year.
Right.
They've continued to bounce back because, now you look at the NASDAQ up almost 4.52, up 13% year to date. Emerging markets also had an incredible week, up 7%. They were the big winner last week. I'm starting to I was doing some more diving into emerging markets. And the more you look at the emerging markets, it's actually somewhat very much tied to the AI trade. Taiwan Semiconductors in there, Samsung,
South Korea and Taiwan are the big two.
You look at all of those components. So that's really what's driving a lot of the emerging markets. I don't know if it's necessarily the growth across all the emerging markets that's been great. In fact, a lot of these emerging markets are going to take a potential hit economic-wise because of higher oil prices and et cetera because of the Iranian conflict. But really, it's all AI right now, and it's this AI build out. Now it's moved to the memory chips.
Yeah, that's the interesting thing that we've seen. It was the Mag 7.
Yep.
Yeah, they were going to build out all the AI, and they are still building out.
They're the ones funding it all.
Yeah, but they're spending hundreds of billions of dollars. But now they need, all of a sudden, they found out they need these memory chips. So the companies that make memory and storage are the ones that have exploded. And that's DRAM, basically. You saw Intel go from $15 to $100.
Well, Intel's the CPUs, but DRAM, so it's a new ETF that we're going to talk about today on the show because I think it's important to watch. So DRAM, ETF that got launched by Roundhill just on April 1st. They nailed it in terms of when to launch an ETF. It's been the fastest growing ETF in the history of ETFs. Besides, you kind of go back to iShares, LQD. That was a really big one that grew very, very quickly. There's been a couple over history, but this one's in that same ballpark where so many people have allocated to DRAM. I think it's over $1 billion in a matter of weeks. And what is DRAM? Well, DRAM gives you exposure to three main companies, Samsung, SK Hynix, which is basically the big maker. Those are two South Korean companies that make memory chips, and Micron. About 75% of the ETF is in there. You get a little bit of SanDisk, you get a little bit of Western Digital and some of the other kind of storage companies as well. But this ETF, I think, is up almost over 120% in 1 month.
Wow.
And so it's just exploded. Even looking at it today, I think it's was up another 5-6% today. But I think this is a key chart to watch. And I always like to talk about proxies. And I got a little bit of commentary on BIZD not being the right proxy for private credit. And yes, 100%. It's not the perfect, sensor of how private credit's doing. The best sensor of private credit is credit spreads, and credit spreads have remained really benign over a period of time. But I think DRAM is also another way of just being able to assess this AI speculative, this infrastructure spend. And right now it's clearly in a bullish, ultra bullish, parabolic type of move. But I think it's going to be important to watch when this maybe tops out or changes, what does that composition of that change look like? Is it going to come back and then recover and then continue higher? Are we just going to continue to go to the moon, then pull back? But I think you can now, we have you didn't have an ETF that kind of, it was so centered upon this one component of the AI data center infrastructure build out.
Right.
Now we have a proxy to really check.
I
and
don't
see how
know,
things
because
go.
it might shift to something else. Like we had the Max 7, and everybody said, oh, the Max 7, and now we've shifted from the Max 7 to the DRAM.
Well,
But
no,
then-
I mean, because everyone still talked about the AI infrastructure build. You know,
Right.
everyone was talking about energy, right?
Right.
Energy was saying, oh, we have an energy bottleneck, right? So we need more energy, so invest in the energy companies. Okay, now we have a chips bottleneck, and we have a CPU bottleneck, so now invest in those companies. Well, unless they're going to start putting, I don't know, wheelbarrows in data centers, and we need to start investing in the wheelbarrow companies, there's only so many components that go into the data center companies. So I think we've checked all the boxes in terms of all the components, but now we can really, we've gone through all of those components. It starts with TSM, you know, that makes the chips, and it goes to all the silicon, so the semiconductors, they have been running up for a while. Now it's, you know, even, you know, you look at air conditioning cooling, right, for the data centers. You look at fiber optics, all of those components, and they don't add up to a big portion of the S&P 500. Right? Even though they've gone up a lot, they're going up 100%, and you know, Micron was tiny. If you have a 1% position of Micron in your portfolio, I think you're overweight, you know, that position relative to the S&P, yet they're driving all of the returns. And that's just one of the things that I think you just want to be cognizant about, and things that we'll talk a little bit more about portfolio management when we're talking about the technicals and the charts, is that, you know, things are great. Clearly, I mean, we're now, you look at the 3-year cumulative return on the S&P, it's been 86%, 86% 3-year cumulative return in 3 years, right? Divide that by 3, we're pushing 30% returns for the last 3 years, right? I mean, that's, beyond anyone's wildest imaginations, and great. But I think the thing that you want to look at, and what we've been talking about over the last couple of weeks, is not saying that things are going to crash or that things are inevitable. In fact, but it's just things are rich, they're getting richer, they're getting a little pointier. Diversification is your friend, and you want to think about, how do you diversify? The first logical place to think about when you're looking at diversifying is just diversify your equity positions. You don't need to sell your stocks and buy bonds. You don't even need to sell your stocks and buy high yield bonds, because that's reducing your beta. But just make sure that you have a nice broad range of stocks. Because if you're only focused on just a couple of these stocks, yes, they're going up right now, but if you're not locking in those gains, and that's what we've talked about, you're happy. But what I hear from people is that, you know, they ride that up and then they ride it back down, and they
You
say,
live by the sword, you die by the
exactly.
sword.
And then they come and talk to us, but then there's nothing you can do at that point. You've went up, you went down, you didn't make any money. It was great, you were up a ton, but it's, as you say all the time, it's not what you make, it's what you keep that counts. And so I think now's one of the key times of diversification. Money, clearly, but we're also getting ready for potentially what might be coming, which will be more volatility. And I think DRAM is really going to be one of the key things to really monitor, of really when, you know, the euphoria or the animal spirits around these AI memory chips is really coming to an end. Right now, we're in the go-go times.
Technology was up 7% last week. Tremendous week. Energy was down because there was a ceasefire, and we were expecting
Ceasefire, wink, or
we were expecting a response from Iran that they would say everything's fine, but everything. President came out and said no, it's not acceptable at all, and Netanyahu came out and said there's a lot more work to be done. So where do we go from here? I think that's in the short term going to dictate, and it's the Straits of Hormuz. When do they open? Can they open it? Can we see oil supplies?
I don't think so. I think the market at this point, the bad news for Iran is out. Like we said, the oil prices are going up. They're continuing to go up. Interest rates are going up. They're continuing to go up because of inflation.
And the market doesn't care. Well, sooner or later, one morning it might wake up and it cares.
But it's only going to care once the psychology around the AI changes. It's not. I don't think the Iranian situation.
So nobody cares about oil going to $125 a barrel and slowing down the global economies.
I care.
Yeah, I know, but people. This market is writing two things. First, it's profits. Profits are up 28% earnings.
Correct. Yeah.
Crazy number.
Crazy number.
So companies are making tons and tons of money. And the second is consumer spending. People are still spending like it doesn't matter.
let's go back to the first point there.
Okay.
A few companies are making crazy money, not all companies. So one of the things I wanted to highlight, I was looking at it today, RSP, it's an ETF, RSP, it's equal weights the S&P 500.
Right.
It hasn't made any new highs. We don't have a chart of it. We don't have a chart of it today, so we'll get back into it. But this talks about, we do have a chart of the week that shows that there's, so far this year, of the S&P 500, there's more underperforming stocks of the S&P 500 than outperforming stocks. Yet, the ones that are outperforming are a few subsect are pushing everything up, right? SanDisk is up 380% this year, right? Is up the biggest stock. It's a tiny stock, but it's up the most. And so because these stocks are up almost 400, 500, 600% in a matter of months, they're pushing all of the S&P. But if you look underneath, it doesn't look great, and now I start to look at the GDP. The GDP is now 100% AI data centers. I don't know how many listeners are out there basically involved with the AI data center industry or were involved with the AI data center industry. I doubt there's not, maybe there's just a couple. And so it's starting
It's very narrow, that's what you're saying, and we need to broaden out this market. I think it will. If oil starts to come down, I think the rest of the companies might do better.
Oh, absolutely. But oil's not coming down, it's going up.
That could be a problem. That's why I'm saying it could be a problem for the rest of the companies. And sooner or later, that's going to catch up. That doesn't mean you go and sell everything.
Yeah.
Please don't misunderstand.
No, exactly.
It's just having the right allocations and not getting too tied up in having all your money in two stocks and saying, oh, yeah, let's go. And you're going like gangbusters right now, but when it turns, it's going to turn with a vengeance, and you give it all back. So it's fun to write it up, but again, you want to keep it. You want to sort of chisel some of it away and diversify it. That's the key. Oil back up today. This is as of Friday. Friday, we get unemployment data also. It was great.
Yeah, Friday, I wouldn't say it was great, but it was good. I mean, it was definitely 150,000, 55,000 jobs. So it's definitely, people are not getting, the economy is doing fine. I mean, the economy is doing, continuing to do, I would say, okay. I just don't know if it's doing 500% return, 30% annualized returns okay, in terms of like that type of growth. But it is.
It is what it is.
It is what it is. We'll take it. But I'm just saying, enjoy it.
But at the same time, be cautious. That's all we're saying.
Now is the time to just diversify. And however you want to diversify, you don't necessarily need to reduce risk, but just make sure you're diversified at this juncture, and that you're going to be fine. Once again, all the Compak clients listening out there, you are diversified. We're doing that on a daily basis.
Interest rates didn't go anywhere last week. They started at 4.39, ended at 4.38. So but today they're going up with the oil prices back up. And what I don't like about today's oil price, and I'll show you the chart, especially the daily DBO chart, that's something that I really don't like, and I'll show that to you. So here's oil reserves. We'll
get back to oil in a second, but just talking about, we'll talk about the bond. I talk about high yield markets. AGG was actually up last week, just a little bit, 0.26. Hasn't been great year to date. It's been flat. High yield also up, but just up 0.05. And I'll show you the high yield chart, my relative strength chart. But basically since April 17th, so we're almost going on 1 month, high yield's been gone nowhere to slightly down, which is not a big worry, but it's just saying it's also not, I don't see, all of this commentary, I guess you would say, about this explosive growth that we're going to get from AI and the productivity gains. I'm not seeing it really anywhere in the market. We're seeing it in the stock market, in some of these stocks that are benefiting from the AI infrastructure. But you look at the companies and how much they're actually using AI. You look at these McKinsey surveys. People are kind of, it's a glorified search engine at this point. Now, is agentic AI going to come out and really start replacing employees? But in my opinion, that's actually, while it could be good for shareholders, I don't know how it can support consumption, because the poor guy who works at Microsoft making $300,000 a year, he's middle management, et cetera, he gets replaced by a computer, and he has to go and maybe get a job for $100,000. That's now $200,000 that's no longer going into the economy. Right? That, yes, it's going to be saved by Microsoft and the shareholders will be doing fine, but that guy's not consuming anymore. And so in my opinion, I view AI as being more disruptive than maybe, all those productivity gains. Now it depends on where you're at, And once again, as shareholders, we don't really care if it's that disruptive. What the key thing you really want is earnings, of your investments, and because you're the shareholder, you're the owner, you're the CEO in many ways, of owning the company. But when you look at it from an economic perspective, I don't know. So continue to watch the high yield, I think, is really key.
Which was something not up as much as, this is the first week I've seen in a long time.
But I think particularly if we start to see high yield come down,
Right.
and it's going down faster than the bonds, than your AGG bonds, that's my big kind of worry sign. And there's a bunch of other things that I've looked at, like inflation, right? And we're going to talk a little bit about oil and inflation. We saw a big correction in the 1 year break-even inflation rates. They went from like 3.5%. They just dropped all of a sudden that second week in April. But I don't know if that's because oil prices are going down. I think that maybe the market, and this is very early, is beginning to price in a slowdown in the economy. Not in the stock market. Clearly, we're seeing all of that. And then particularly what we've also seen is the 10-year break-even inflation rates have started to go up. And I haven't seen that. The only time we saw that was back in 21, 22, when we spent $4 trillion, during COVID. We're not spending, that amount of money. Now, a good portion of that, $600 billion, is going into AI infrastructure. But it's not, wide breadth, like spending like we were giving out, unemployment insurance and everything else during COVID. But my point is that, okay, short-term inflation is coming down, yet oil's going up, and long-term inflation is also, expectations are going up. That's what we call stagflation. And stagflation, it's really hard to call because it's such a tail-end event. It's really hard for stagflation to be around for a long period of time, and it's very rare, number one. So you can't really call for stagflation, but you're starting to see a little bit of those ingredients. And that's just another little bit of worry where, interest rates could go up and GDP is going down. Now that's also,
That's not a good sign.
You're going to see volatility. AI build out still might happen, still might be, still going to happen, but you're definitely going to see some volatility.
So if you own stocks, you're good. If you've got a job, you're not.
Yeah, exactly.
Looking at oil
Which is most
reserve.
of the retirees out there.
Yeah, look at the global oil reserves. Look at China. They've got a tremendous amount of oil stored.
So once again, for our podcast listeners, we're on YouTube as well. So you can always just go to compak.com/YouTube to see these charts. But we're looking at a chart of oil inventories. And basically, China has the most strategic oil reserves. And particularly, they can cover their net imports for 120 days. Japan can cover their net imports for almost 205 days. So there is a lot of still reserves available if we continue to see the Iranian conflict continue to play out. However, it's still pushing up prices. So it's not the Armageddon scenario. A lot of people are talking about, Europe, for instance, there's going to be no planes. There's going to be no jet fuel. Well, they have 130 days worth of, imports that they can still cover from their strategic reserves. It's not a long time, right? And so if this continues for longer than that, but I really feel, right now, where are we? May, June, July, particularly as oil consumption picks up, typically over the summer, right? People start driving here in the United States. And we're going to talk about, a lot of people have said, well, U.S., we're a net exporter of energy. Why are we have $6.50 of gas here in California?
I think this next chart shows that.
Well, this is another chart where we always like to educate all of our listeners here in Market Wrap. Well, there's different types of oil. And there's heavy oil and there's light oil. And this depends on how much thickness of it is. Well, the U.S., we export all of the light crude. So if you think about shale, that's all light crude. Unfortunately, we don't have the refineries capabilities here in the United States to then refine that crude so we can use it here. All of our refinery capability has been built out since the 70s, 80s, and 90s, and it's all based on heavier crude, which comes from the Middle East. So because we still import the heavy crude and all of our basically
most of the
energy
heavy
infrastructure-
crude comes from Venezuela and Mexico. It's light sweet crude that comes from the Middle East.
Yeah.
That's what we're seeing, and we produce a lot of light sweet.
A lot of crude also comes from Canada as well.
Yeah, that's heavy crude.
Yeah.
That's really heavy tar shales it comes from.
Yeah.
And so we'll have to wait and see exactly how this plays out. but we have the refinery capacity, but the oil that we are producing here in the United States
We can't
is like
refine.
we can't refine. We export that,
Yep.
and we have to import heavy crude to refine it, and that imported heavy crude is going up in price, and it's causing prices to go up here, but not as much as it is in Europe because they have no oil.
Correct. So then once again, everyone kind of says, oh well, I thought we're a net exporter of energy. Well, you have to get in one layer deeper and look exactly of the type of crude, what's being used, how can you actually use it. And so, yeah, higher oil prices are good for the energy sector, and that's why I think we go back, we look at energy stocks. They're up 20. They're the highest sector up this year. They're up 25%. Energy sector stocks are up. Technology is the next best sector at 16%. S&P is up 8.5%. Financials are down. I don't love that. Healthcare is also down, but financials down. Financials are also usually when things are good, right? Financials tend to be up as well. So really interesting dynamics, and then we'll get into the charts here to really talk about. But also we're going to get a lot of data this week, on the economic side.
We do. Last week we got unemployment data, but this week we get important data. We get CPI tomorrow morning. We get PPI on Wednesday. Then we get retail sales. It shows how the consumer is doing. And those auto sales, and we get a lot of other stuff. But CPI, PPI, and retail sales are the three most important ones.
Well, and I think the CPI numbers are going to be important, and how you're going to read that is how does that translate into the 10-year Treasury, right? If we see a big spike up in the 10-year Treasury, clearly that's going to be the catalyst for a pullback in the stock market, and that's all being kind of driven by kind of the composition of the inflation. Because one of the problems with oil, and this goes back to, is this an energy shock or is this a geopolitical situation within Iran? But one of the problems with oil is that it kind of affects everything, right? Because you have to transport all of these goods, and if the cost of transporting the goods go up, well, the goods themselves go up, even though oil is not used directly in those goods. So we need to kind of see how that all plays out. Going forward, I think the other big item this week is President Trump is meeting with Xi Jinping on Thursday and Friday. So, we'll see how that goes.
Anything can come out of that. We just don't know what's going to happen out of it.
I don't think a lot's going to come out of it. I think, unfortunately, for better or worse, President Trump has his hands full with Iran. Right. So if he really wants to, double down and slap huge tariffs on China, I don't think the market's going to appreciate that at this point. From a geopolitical standpoint. So I think this is something to watch. I think the other thing is also Chairman Kevin Warsh is expected to be appointed this Friday as well. I don't know. Looking at this 10-year Treasury chart, the short-term inflation, now there's some talks about raising interest rates.
I don't think Warsh doing anything at this point. He doesn't.
But I think he's going to get tested. I think the market always likes to test these new Fed chairmen. I'm just saying.
Yeah, they do.
So he's gonna say, okay, buddy, let's see what you got. How are you gonna manage a situation? And I think the key thing, as we always talk about, so we talk about it every week, is that 10-year Treasury chart. If that breaks above some of the levels we'll talk about here shortly, it's going to be really kind of dicey in terms of where things head from here. But
on the other hand, let's look at the positive. I was worried about this being wave 5. We talked about that.
Fifth wave.
Fifth wave.
This is we're looking at an S&P daily chart.
And we had this resistance here. We broke right through it, and now we've got an extension, and the wave 5
But why is the extent? It's huge. It goes from 7,700 up to 8,200. I mean,
that's the first target is 7,800. Then it's 8,150. That's the next one.
8,150. Because I was looking Yardini. I like to follow Yardini. Really good information.
Right.
Basically, he had his he raised his ending year target from 7,700 up to 8,250.
Right.
So it's very much kind of in line with potentially these this could be that extended fifth. We talked about it. You get the fifths, but then you get this euphoria fifth.
Right, which just extends up, and that's what we're seeing. So it's breaking out basically through resistance, and as I showed last week, that if it breaks as a weekly chart, and the target was right around 7,300 or so, and you can see the market is up here now. It's broken up, and the weekly targets, extension of the fifth wave.
8,200.
8,200. So Are we
We'll
going to
take
get
it.
it? Yeah,
Hey,
I'd love to
I-
take it. We
yeah.
were 7,400
We're,
today.
we're long the stock market, people.
Yeah,
so
exactly. We
let's-
love the stock market
Yeah.
going up.
Yeah.
So if it just goes parabolic and goes straight up, wonderful. We'll enjoy it and,
Yeah.
and go with it. But same thing with the Nasdaq. It was showing a fifth wave. Now it's showing a third wave extension, going to 28.
And this is one of the things I think we always got to kind of caveat with Elliott Wave is that as targets get exceeded, then the wave counts can change.
Yeah, and this is something we were looking at a target right here of 25,000, which was our target from last year. And here we are right through it. We're 26 is in a quarter today, and the target becomes 28,000 to 29,000.
Okay.
That's the next target on. So markets look like they have room, but again, it's just parabolic markets, and they scare me when markets get parabolic.
So stay invested, and then prepare. Maybe look to diversify, but you don't necessarily need to be reducing your risk.
That's the problem. That's what people do. They reduce risk. And I always say, look, you never know where the top is going to be. Picking tops and bottoms can be hazardous to your wealth. Just like smoking can be hazardous to your health. Like they have that little sign on the side of cigarette packets.
Yeah.
They should have that on the market. Trying to pick tops and bottoms can
Yes.
be hazardous to your wealth. So don't try to pick the top. Let the market do that for you. And as I always say, if it goes from 7,400 to 8,200 and
back.
corrects back to 7,600, but you sold at 7,400,
Yeah.
did you do the right thing? No, you didn't. That's why you have to have the diversified portfolio to be able to handle the volatility when it does come. And we don't know where the bottom is. We don't know where the tops are.
Yep.
That's the thing that you need to avoid. And that's where the emotion comes in.
Yep.
It can't go higher. This is it. Or it can't go lower because this is such a great stock.
Well, and then if you do sell and you get into that position, then you're just kind of
You're stuck.
You've anchored yourself there.
You're stuck
And so as
because
it
you're
goes
saying,
higher,
I can't buy it higher because it's higher than where I sold it. I'm going to wait for a pullback.
You've created an artificially kind of psychological barrier to then getting back in. So
You
that's.
put yourself in a psychological box. That's what you've done.
But I think the key thing is, once again, don't necessarily. We're not getting any sort of signals that this is the top. In fact, we're getting signals that the top could be higher. But I think this is also the time when diversification, particularly within your equity exposure, makes a lot of sense.
That's what we're trying to say, folks. And that's what small caps down a little bit this week. And that's because, especially today, oil prices, I think, are affecting
Well, I mean,
small.
one of the things, I looked at VIX. VIX was up, market was up marginally today, 74.12 got on the S&P, but VIX was up almost 7%.
Yeah, it was a
Someone was buying some puts today. So.
Yeah, someone was buying international stocks. Again, we're looking at a fifth wave, but now it's become a third wave. So we could get a fourth wave pullback and then a fifth wave higher. So everything is looking much better than it was. What is not looking good, we gapped up here. Gap down, left what is called an island bottom.
On oil. So
Oil.
we're looking at a DBO chart.
Right.
Which
and
is the futures. It's not just the spot oil, but we're looking at Western crude. And this is the futures. DBO looks at the futures contracts. I don't know exactly how far it goes out. I think it goes out a couple of months, maybe 6 months or so. But oil prices are going up.
Right. So they gapped up today, leaving an island bottom, which is usually turning points. Island bottoms and island tops are usually turning points in the market. So we left an island bottom. What does that mean? We've turned back up. Are we going higher? And if we break out about 23.5, which is the DBO high, then we're looking at much higher oil prices.
Got it.
And I don't like that. I don't want to see, will this be because of a war restarts in Iran or what happens? Who knows?
I think the big question for the market with Iran is if things remain as they are today, right? Which I think is the baseline.
Right.
Right? Is
Right.
this the status quo? Is the Strait of Hormuz is closed?
Right.
There's a blockade on Iran to put pressure on them to weaken their economy because they're basically not doing business, right? If that situation becomes semi-permanent, what is the fair market value price of oil?
I think it was around $100 a barrel. That's what everybody figured out.
Okay, so that's where we're at now.
Right. But if we see fighting start again,
Yeah, I mean, I think you agree. The only way it potentially gets worse than $100 to $120 a barrel or 100 is if Iranians really do start blowing up some Middle Eastern infrastructure. It's not the U.S. blowing up Iranian infrastructure.
If we try to get through Operation Freedom again, where we start trying to get ships through the Straits of Hormuz, Iranians shoot at them, we shoot back at them. Do we have a ceasefire anymore?
But I don't think that affects the market.
But then the Iranians did what they did last week, where they started firing at Dubai, UAE.
I think for
the
market
ports there.
yeah, exactly. If the Iranians start to attack Middle Eastern infrastructure, that is the game changer. And the U.S., in many ways, because of the way the drones work, all these, they can't stop it.
Nope.
And so then it's not, that's my point, is that it's not in the U.S.'s hands. It's really in the Iranians' hands in terms of where this thing wants to go, how much pressure do they want to put. There's been talk about, these reports were leaked. I talked about it, about Russia now giving, now these drones, the drones used to be operated by radio signals. But then, this is particularly over the situation between Ukraine and Russia. But then they figured out, okay, we can jam the radio signals and then make the drones useless. Well, now they attach a fiber optic wire to the drone, and that thing can go 40 kilometers. So it's a little wire. It's basically a remote controlled drone, but it has a wire, but it can't be jammed.
It's like flying a kite.
It's like flying a kite, but it's got a missile on the end of it. And so then basically those are the drones that are now being supplied, or potentially, according to this document, we don't know if they are or not, et cetera, but Russia is supplying those type of drones to Iran, right? So then they can
There's no way to stop them.
You can't stop them. And so that's the point, is that Russia now, talk about, okay, maybe I think Russia in many ways might be pivoting away from Ukraine and pivoting towards Iran and saying, hey, why do we got to fight with Ukraine? We got more leverage. Ukraine has no leverage. We thought Ukraine, maybe they would come in, they want to defend it, NATO, all these other things. This is better over here. Let's go, because we're not only disrupting the entire oil infrastructure, but we directly benefit by all the disruption, because Russia is a huge exporter of energy. The more the Strait of Hormuz is closed,
the more
money the Russians make. So the Russians have an economic incentive to disrupt or continue to support the closure of the Strait of Hormuz. And so that's one of my main reasons why I think the status quo kind of remains for a long period of time, because now you have a war machine, Russia, that can supply a lot of stuff. The Iranians can't do it, but if Russia's supplying them, what is the U.S. ultimately going to do to Russia to stop that? Well, they're not going to do much. We've already tried to do a lot of things with Ukraine, and things kind of continue the way they were.
As a matter of fact, we lifted the oil sanctions on Russia. They can sell as much oil as they want to at double the price. So they continue to benefit. That's something we have to watch very carefully. So it is in Russia's interest to prolong the closure of the Straits of Hormuz.
Absolutely.
Because they can sell all the oil they want in the world and get a lot of money for it.
Yeah, and so that's why I think this situation is not quite, it's a dangerous situation.
But then we have to look at China. China gets a lot of oil from the Middle East.
Yeah, and Russia.
And Russia.
Yeah.
So maybe they'll get more from Russia and rest from the Middle East.
Exactly. It's going to strengthen the relationship between Russia and China over a period of time. So we'll see, but it's just DBO chart's going to tell us, where this is headed. The weeklies, maybe we get a pullback.
We did get a pullback last week. Now we're back up again. We get above 23.5. We close at 22.12 for the DBO. That's the ETF for oil. It gets above 23, it would not be good. Treasury yields are back up.
What's your warning sign on treasuries? The 4.5 for me.
4.5 is right here. Yeah. These are the double tops right here.
Going back. This goes back to 2025.
Yeah, last year, April.
And right before that goes back to May. The interest rates really spiked last year in 2025. They got up to 4.6. That's when we passed the big tax bill, and then they've been coming down almost. But I think if we get above that 4.5, 4.6.
We've got a problem.
Well, I think that's your catalyst for the stock market's not going to go higher at those particular levels, just because it's just too, even though you have all of this excitement around AI, the burden is just too high from a discounting standpoint on rates. But I think it's time, once again, look at your bonds. If you got cash, start to put some of that cash to work, in some of that fixed income.
Gold is going nowhere. It's
Yeah,
just
I'm starting to get a little bit more constructive on gold. I think particularly if the market is not quite pricing in all of these situations on gold, people might start getting back into gold as that
I
hedge
think
against
central
you.
banks are selling so much gold. That's last year
Yeah.
they were buying gold. Now they've been selling gold.
But but having a little bit of gold can add clearly some diversification.
That's what it is.
Which and that I think that's once again, diversification is your friend. At this particular juncture. Final chart of the week is just looking at HYG to AGG. You can see that red line is basically HYG has been going sideways, yet the relative strength line, the yellow line at the bottom, has been going up since April. So, not getting any sort of recessionary vibes yet.
But in
S&P
May, it's gone nowhere.
Yeah, since May, it started to come down a little bit, but you got to look at the overall long-term trends. And once again, S&P is up 4% or so just from that April 17th date, which is high yield going down. So we'll continue to monitor this very closely, but it's one of those things where if we start to really see that relative strength chart come down, particularly I think it'll be interesting to see, if interest rates do go higher. Right? If oil goes higher, these inflation expectations continue to rise a little bit in the short run, clearly interest rates are going to go higher, right?
Right.
And so AGG is going to sell off, but once again, I'm going to also watch HYG.
Relative to AGG.
Exactly.
When
we've seen basically throughout all of the previous rises in interest rates, you go back to 2021, 2022, yeah, interest rates rose, not great. Hopefully you locked in your mortgage and all of those other long-term debts, et cetera. You weren't too long in your duration on your bonds, but AGG held up. So the key thing is always this: if interest rates start to rise and AGG doesn't hold up, right?
That's a warning
That's
signal.
your warning signal that this time probably might be different when it's looking at the overall kind of dip that we experienced due to the rising of the interest rates. So we'll continue to monitor it.
Those are our thoughts. So it's a lot of cross currents right now in the markets. Earnings are great. Spending is great. Unemployment is okay.
Not getting any sell signals.
No sell signals, nothing yet. But market is going parabolic. When it goes straight up, you have to watch it. If oil breaks out above $120 a barrel, interest rates break out above 4.5%, I would be cautious. So if you want, by the way, go to the subscribe, click on the subscribe button, or send us an email at invest@compak.com, or give us a call, and we'll be more than happy to sit down with you, talk to you, and develop a plan for you. All of that is free. Those are our thoughts. Those are our observations for this week. We will be back with you next week. Until then, good
trading.
This presentation contains the current views and opinions of Moe Javaid, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.